Imagine you're looking at a company's balance sheet, right?
Okay.
And they have like $500 million just sitting there in the bank.
Which is a pretty healthy position to be in.
Right. And their revenue is absolutely exploding. It's up almost 400% over the last year.
Oh, wow.
Yeah. And the product they make is in such high demand that, I mean, literally the biggest tech companies on earth are practically begging for it.
It sounds like a dream scenario for a business.
You would think so. But despite all of that, this company still has to aggressively dilute its own shareholders just to keep the lights on, just to, build enough factories to actually survive the demand.
That is wild. But honestly, it perfectly highlights the brutal, capital-intensive reality of actually manufacturing the AI revolution.
Exactly. And welcome to today's deep dive. Because that friction between the speed of software and the really heavy physics of hardware is exactly what we are unpacking today.
It completely shatters that illusion, I think, that we all have about AI being this weightless, ethereal thing.
Right, the cloud.
Yeah, exactly. The cloud. We ask a chatbot a question, the answer magically appears on our screen, and we just assume it's all, clean software floating somewhere.
But the physical reality of AI is heavy.
It's incredibly heavy. It is millions of miles of specialized fiber optics. It is massive warehouses that consume the electricity of a small city, and it requires just a staggering amount of industrial hardware.
And for this deep dive, we are looking at the financial disclosures, the SEC filings, and all the market data for a company called Applied Optoelectronics.
Usually just called AAOI in the market.
Right, AAOI. And the mission here today is to cut through the massive hype surrounding the infrastructure side of AI.
Which there is a lot of right now.
So much. We are looking at a company whose stock shot up 427% in a single year. And we really need to figure out if that is just, market euphoria, or if it's a fundamental, sustainable transformation of their underlying business.
Because if you were watching this whole AI supercycle unfold, you're likely wondering who is actually capturing the real durable value out there.
Because an AI software company, they can scale to 1 million new users over a weekend with almost zero marginal cost.
Right. But a hardware company, like AAOI, they have to physically go out and buy land. They have to build these massive clean rooms, hire engineers just to scale up.
Which brings us to the sheer scale of what AAOI is actually attempting to do right now. To set the stage for you, the stock has been incredibly volatile.
Very.
Over the last 6 months, it's up 184%. And as of late August 2026, it's trading around $124.
Which is in a bit of a corrective phase right now.
Yeah, it's down from a high of over $233. But, it's still massively elevated from its $18 low last year.
$18 to $233 is just a crazy run.
It is. But you don't get a chart that looks like a volatile heart monitor without some serious underlying revenue acceleration driving it.
No, absolutely not. And the jump in their revenue, it's the kind of data point that makes you pause and reread the SEC filing just to make sure you didn't drop a decimal point somewhere.
Wait, really? How big of a jump are we talking?
So in the second quarter of 2026, they hit $191.9 million in revenue.
Okay, 191.9.
Right. And to put that in perspective, that single quarter is almost equal to their revenue for the entire first half of 2025.
Wow.
Yeah. The whole first half of 2025 was roughly $202.8 million. And they just did almost that in one quarter.
It is the equivalent of a regional auto parts manufacturer suddenly winning an exclusive contract to supply every major car company on the planet.
That's a great analogy.
The math of your entire business just completely changes overnight. You aren't just doing more of the same thing. You are operating an entirely different organism at that point.
Exactly.
But the immediate question that comes to mind, and I'm sure you're wondering this too as a listener, is sustainability. Is the market underestimating this sequential step up? Or is this just a massive one-time surge that they are never going to be able to replicate?
Well, if you look at management's own guidance for the third quarter, it suggests they believe this is a new baseline. It's not a blip.
Okay, so they expect it to continue.
Right. They are forecasting Q3 revenue to jump even higher. They're looking at landing somewhere between $255 million and $290 million.
That is a massive leap.
It is. But honestly, the top-line revenue isn't actually the most important part of that Q3 guidance.
What is?
The real story is the bottom line. They're projecting a shift from consecutive net losses to positive non-GAAP earnings per share.
Okay, that is huge.
Yeah, they're guiding for somewhere between 11 cents and 26 cents.
Let me break down why that non-GAAP EPS number matters so much for you as an investor or just as an observer watching this market.
Yeah, please do.
So GAAP stands for Generally Accepted Accounting Principles, basically the strict accounting rules that companies have to follow.
Right.
But non-GAAP allows a company to strip out certain one-time costs, like stock-based compensation or restructuring fees, to show you what the actual day-to-day operations of the business are generating in terms of cash.
It gives a clearer picture of the core business health.
Exactly. So if they can flip that non-GAAP EPS from negative to positive at this massive new revenue scale, the entire narrative of the company flips.
It really does.
They graduate from being a company that just burns cash to grow into a company that actually keeps the money it makes.
Right, it validates the whole expansion strategy, but to understand how they even got into a position to guide for nearly $300 million in a single quarter, we really have to look at the mechanics of what they are actually selling to these data centers.
Let's get into the hardware. What exactly are they building?
So these massive AI models require hundreds of thousands of individual servers to constantly talk to each other, right? That's how they train the algorithms.
And they can't just use standard copper wire for that, can they?
No, absolutely not. Copper is way too slow for the sheer volume of data we're talking about. The data centers speak in electrical impulses, but to move that data across a massive warehouse instantly, that electricity has to be converted into light.
And that is exactly where AAOI comes in.
Yes. They build the optical transceivers. Specifically, they're making these 800G and 1.6T modules.
And just to put that in perspective for everyone, the G and T stand for gigabits and terabits.
Right, huge amounts of data.
So these little modules essentially act as high-speed translators. They catch the electrical signals from the AI chips, turn them into light, blast that light through fiber optic cables across the room, and then translate it back into electricity at the other end.
And they do it at billions or trillions of bits per second.
It's just mind-blowing when you actually think about the physics of it.
It really is. And that structural demand for bandwidth, that is the root cause of their revenue surge. Every new cluster of AI chips requires a corresponding web of these high-speed translators.
Right. You can't have one without the other.
Exactly. But having skyrocketing demand is completely useless if you can't physically manufacture the product fast enough.
Which leads us to the critical bottleneck in this entire industry right now, the component shortage.
Yes. And this is where things get really fascinating from a competitive standpoint.
How so?
Because these optical transceivers aren't just empty plastic boxes. They require incredibly complex microscopic laser chips to actually generate that light.
Right.
And right now, there is a severe global shortage of those specific lasers. Everyone is scrambling for them.
But AAOI has them ace up their sleeve here, don't they?
They do. They are vertically integrated. They manufacture their own laser chips entirely in-house.
Oh, wow. So when you control your own supply chain in the middle of a global shortage, you inherently possess massive pricing power.
Massive. While their competitors are literally sitting around waiting on back-ordered components from third-party suppliers, AAOI can just keep their assembly lines running.
That's a huge advantage.
It allows them to dictate favorable contract terms and maintain much higher average selling prices. They aren't just riding the wave of demand, they are actively capitalizing on the scarcity of their competitors.
So because they have their own laser chips, they are aggressively attempting to scale up their overall assembly, right?
Right.
They have a stated forward-looking target to reach a manufacturing capacity of 200,000 of these 800G and 1.6T transceivers every single month.
200,000 a month.
That is an enormous physical footprint.
It is, and it's really the foundation for management predicting a 170% volume growth by 2027.
Wait, 170% volume growth?
Yeah. If they achieve that 200,000 unit monthly capacity, the economies of scale really start to kick in.
Oh, I see. Because the cost to produce each individual unit drops.
Exactly. The fixed costs of the factories are suddenly spread out over a much larger number of products.
There is also a geopolitical angle here that we should mention, because it could theoretically act as a massive tailwind for them.
Oh, right, the regulatory side.
Yeah. The U.S. Federal Communications Commission, the FCC, has been signaling potential restrictions on Chinese optical products being used in critical U.S. infrastructure.
Which would be a massive shakeup.
Right. If the federal government steps in and essentially bans a large chunk of AAOI's foreign competitors from the domestic market, their market share would naturally balloon.
It would effectively shrink the playing field overnight. However, you really have to approach that with a healthy dose of skepticism.
I was just going to say, banking on regulatory optionality is not a sound business strategy.
No, definitely not.
Until a law is passed or a rule is finalized, that FCC ban is purely speculative. You cannot pay your factory workers with pending legislation.
Exactly, which is why we need to pivot and look under the hood of their actual current financial reality.
Let's do it, because incredible top-line growth does not automatically equal financial stability.
Not at all.
When you dig into the fundamentals, there are some very glaring cracks in the foundation of this company.
Yeah, this is where we get back to that brutal tension between software and hardware.
Despite the insane revenue surge, AAOI is actually still deeply in the red.
Deeply.
In the first half of 2026, they posted a net loss of $37 million. Their trailing net margin is negative 9.557%.
Ouch.
Yeah, that means for every $100 of revenue they brought in over the last year, they effectively lost nearly $10.
Right. And more importantly, their operating cash flow for the first half of the year was negative $73.8 million.
Negative $73 million, wow.
They are burning cash at a prodigious rate just to build out the capacity to meet this demand. Which brings us to the single biggest red flag for current shareholders.
Okay, let's hear it.
In August 2026, the company announced a $600 million at-the-market, or ATM, equity offering.
Okay, wait, I have to stop here because this is the fundamental contradiction of this entire deep dive.
It really is.
We talked about this at the beginning. They have $499.7 million in cash and equivalents just sitting on the balance sheet, right?
Yes, plus another $508 million in restricted cash.
So if you have that much runway and your revenue is jumping by hundreds of millions of dollars, why on earth are you hitting your investors with a $600 million dilution?
Because building out the physical infrastructure to produce 200,000 ultra-high precision transceivers a month is terrifyingly expensive.
It's all about the factories.
Exactly. In 2025 alone, their capital expenditures, so the money spent on physical assets like factories and equipment, was over $179 million.
That is a lot of concrete and steel.
It is. They are anticipating that the cost of scaling up is just going to rapidly eat through that cash reserve.
Let's explain how an ATM offering actually works, because it's very different from a standard secondary stock offering.
Yeah, it's a very different mechanism.
In a normal offering, a company sells a massive block of shares to a bank all at once, right? But an at-the-market offering is a bit more insidious.
I would definitely use the word insidious.
It allows the company to slowly, quietly drip-feed new shares into the daily trading volume of the open market over time.
It is basically stealth dilution.
Yeah.
When a company uses an ATM, they are constantly increasing the total number of shares in existence.
So if you own a slice of the company pie, and the company just keeps baking new slices and selling them, your original slice represents a smaller and smaller percentage of the total pie.
Exactly. And it puts a constant downward pressure on the stock price.
And as an investor, you're watching this and wondering if the cash burn will ever actually be offset by real sustainable profits.
Because if they don't eventually hit profitability, that ATM dilution cycle just continues indefinitely until the stock is ground into dust.
That is a terrifying prospect. And that risk is really compounded by the behavior of the people inside the company.
Oh, the insider trading data. Yes.
The market data shows 17 recent insider sales transactions. That's totaling over 327,000 shares sold by executives and directors.
Now, I know insiders sell stock for plenty of mundane reasons.
Yeah. They have to pay taxes, they want to buy a house, they need to diversify their personal portfolios.
Right. I never look at one or two insider sales as a panic button.
But what was the number of insider open market buys during that exact same period?
Zero. Absolutely zero open market buys.
When 17 transactions go one way, and nobody is reaching into their own pocket to buy shares on the open market, it really forces you to pause.
It does.
The company is publicly projecting this massive, highly profitable future. But the people who actually have access to the daily production logs and the internal margin data are quietly taking some chips off the table.
It is a notably bearish indicator for market sentiment, for sure, and it forces us to look closely at the operational risks that could derail this whole growth story.
What's the biggest operational risk you see?
Well, one major risk is customer concentration. The financial disclosures specifically call out a trial customer named Digicom.
Right.
In a hypergrowth phase, if a company is relying too heavily on a single massive channel, or if a massive trial program fails to convert into a long-term binding contract.
Then that beautiful Q3 revenue guidance could just evaporate instantly.
Exactly. The rug gets pulled out.
We also can't ignore the broader ecosystem here, because a competitor in the optical space named Fabrinet recently reported earnings, and they missed their margin estimates.
That was a huge moment in the market.
Yeah, and that single miss didn't just hurt Fabrinet, it triggered a massive sector-wide sell-off across optics and chip makers.
That Fabrinet miss is crucial because it exposes a real vulnerability in the whole AI hardware thesis.
How so?
The assumption has basically been that because demand is so high, these companies can charge whatever they want.
Right, unlimited pricing power.
But the margin miss implies that even in a supercycle, pricing power is not guaranteed.
Because the mega-cap tech companies buying these components are ruthless negotiators.
Exactly. If the cost of raw materials goes up, or if the tech giants just force the prices down, the gross margins shrink.
Right, it just becomes a race to the bottom.
Yeah.
And AAOI currently has a trailing 12-month gross margin of around 28.9%.
Which is okay, but
But if that number starts to slip because of sector-wide pricing pressure, their path to actually turning a net profit gets exponentially steeper, no matter how many units they sell.
So we have established the deep tension here.
Yeah, we have massive top-line acceleration and a brilliant strategic advantage with those in-house laser chips.
Completely at war with heavy cash burn, impending shareholder dilution, and industry-wide margin pressures.
So to figure out what happens next, we really need to map out the two extremes.
The best and worst case scenarios.
Exactly. Let's start with the blue sky scenario. And keep in mind, for everyone listening, this is an optimistic projection based on the math. It is not a guarantee.
Right. This is if everything goes perfectly.
In the blue sky world, they absolutely crush the Q3 guidance. They hit the high end of the $290 million revenue mark, and more importantly, they achieve that positive EPS.
They prove they can actually make a profit.
Yes, that momentum carries into 2027. They hit the 200,000 monthly unit capacity without a hitch, and that Digicom trial converts into a massive multi-year contract.
If all of that happens, the financial mechanics of the company completely transform.
How so?
Well, the massive capital expenditures peak and begin to decline because the factories are already built.
Right, the heavy lifting is done.
Exactly. And then the operating cash flow flips from negative $73 million to wildly positive. At that point, the market fundamentally reevaluates the stock.
It is no longer priced as a risky, cash-burning microcap, but as a foundational, highly profitable pillar of the AI supply chain.
Exactly. That's the dream.
But the sky isn't always blue. We have to look at the thesis breaker. What is the scenario where this all just falls apart?
The ultimate thesis breaker is a failure of conversion.
Okay, explain that.
If they report Q3 earnings and the revenue comes in hot, say they hit the $270 million mark, but they still post a net loss per share.
Because the margin slipped.
Yeah.
Or the ATM dilution just ate all the profits.
Exactly. If revenue is growing, but they are still losing money on every single unit because of scale inefficiencies or pricing pressure, the stock will be punished severely.
Because the market is currently tolerating that $600 million dilution threat purely because they believe the profitability is imminent.
Right. If management fails to deliver that positive net income, investors will realize they are just funding an endless science project.
Wow. An endless science project.
Yeah. And then the multiple compresses, the stock crashes, and the dilution required to raise cash at those lower stock prices becomes a total death spiral.
It sounds like literally everything hinges on this upcoming Q3 earnings report. It is the absolute crucible for them.
It really is.
Let me make sure I'm crystallizing this for you, the listener. If they hit the massive revenue number, but they fail to break even on the earnings per share, the entire narrative that they have reached a profitable scale just falls apart.
Yeah, it would completely shatter the market's confidence in their capital-intensive strategy. The Q3 guidance is the absolute backbone of their current valuation.
That makes total sense.
The reason the stock is in a corrective phase right now, kind of lagging behind the wild revenue growth, is because the market is just sitting on its hands.
Waiting for proof.
Exactly. Institutional investors are waiting for undeniable proof that AAOI can generate real net income after years of successive losses.
So, bringing it all together, we have unpacked a really fascinating real-time case study today. We watched Applied Optoelectronics evolve from a relatively standard optics manufacturer into a company desperately attempting to build the heavy physical infrastructure required for the AI revolution.
We've seen the mechanics of their massive revenue acceleration and their Honestly, brilliant strategic move to vertically integrate their laser chip supply.
But we've also weighed those triumphs against the brutal realities of hardware physics. The massive negative cash flows, the concerning lack of insider buying, and the looming threat of drip-feeding $600 million worth of new shares into the market.
It's a lot to weigh.
For you, as the listener, if you are tracking this stock or this broader infrastructure sector, you only have one job moving forward. Monitor the upcoming Q3 earnings report.
That's the only thing that matters right now.
Ignore the noise, ignore the top-line revenue hype, and look straight at the earnings per share. If management proves they can turn a net profit while scaling at this speed, it validates their entire grueling journey.
And if they miss, you really have to ask if the friction of the physical world is just too heavy for them to overcome.
It is the ultimate test of whether a company can bridge the gap between building the future and actually profiting from it.
It's going to be fascinating to watch.
Which leaves us with a provocative thought as we wrap up today's deep dive. We spend so much time marveling at the software side of the AI boom,
Oh, absolutely. The image generators, the code writing assistants.
Right. And the sheer speed at which these digital platforms scale is incredible. But software is fundamentally weightless. The companies that build the physical world, the companies forging the glass, the lasers, and the copper that make the software possible, they have to fight a daily war against gravity, supply chains, and massive capital costs.
The physical constraints are very real.
So as this supercycle matures, ask yourself, where is the real durable value ultimately created? Is it in the infinite zero-cost scaling of the algorithms? Or is the true power held by the companies that control the incredibly difficult, highly physical bottlenecks that the algorithms cannot exist without?
That's a great question to leave on.
Something for you to keep in mind as you watch this heavy infrastructure sector continue to evolve. Thanks for joining us, and we'll catch you on the next Deep Dive.